Hello, everyone, and welcome to the first official real episode of Esquired. Today, we are going to be talking about insurance. So, this will be the intro to our insurance series. However, before we begin, I do want to give you the daily disclaimer. The information provided on this podcast does not and is not intended to constitute legal advice. All information, content, and materials available on this podcast are for general informational purposes only. Information on this podcast may not constitute the most up-to-date legal or other information. Use of and access to this podcast or any of the links or resources contained within do not create an attorney-client relationship between the listeners and podcast contributors. This includes contributing law firms or guest podcasters. Listeners of this podcast should contact an attorney to obtain advice with respect to any particular legal matter. No listener of this podcast should act or refrain from acting on the basis of information on this podcast without first seeking legal advice from counsel in the relevant jurisdiction. This podcast contains references to third parties. Such references are only for the convenience of the listener. Esquired LLC and its members do not recommend or endorse the contents of the third parties. Okay, great. Now that we've done that, let's jump right in. First, before I begin, I want to talk about some common terms that you may hear me speak about. First are the difference between a policyholder and an insured. A policyholder and an insured are often the same person. However, that's not necessarily the case all the time. Someone can be a policyholder with someone else being insured. So the policyholder is the one that actually pays the premiums and owns the policy, but the insured is whatever is being insured, and that doesn't necessarily mean it's a person either. It could be a house, a car, but just be aware that there technically is a difference between a policyholder and an insured, although they can be the same person. And then an insurer or an insurance company is just the person or the company from whom the policyholder gets the policy. There may be some other terms throughout this particular podcast that I say, and I'll try to pick them up and explain them as I am speaking today. But if I don't, I will try to go through and explain them in the upcoming episodes from this series. Now, to begin, the purpose of insurance is a risk sharing or a risk pooling operation. And what I mean by that is the policyholder pays money in exchange for protection from the insurance company should something bad happen to the insured person, insured property, whatever it may be. Whatever is insured, the policyholder exchanges money to be protected in case of a catastrophic event or, a car accident or something like that. What I mean by risk sharing is that instead of a person being on the hook for hundreds to thousands to millions to billions of dollars, they pay a premium, which is money, usually monthly, to an insurance company that will take on the risk of something if something bad happens. Premium is one of those terms I was talking about earlier that I would need to flag for you in the middle of this episode. And a premium is just money that the policyholder pays to the insurance company. Like I said, either monthly, yearly, whatever the policy is, they pay that money in to their insurer. Now, what I mean by risk pooling is different. For risk pooling, the insurance company will collect premiums and put them all into a pool, which is the collected premiums money from all insureds. When the insurer pools that money, the insurer will then use those pooled funds to pay any claims from injuries to people or property, etc., whatever the policy insures for. And what I mean by pool, when I say that they put the premiums in a pool, obviously I'm not talking about, the thing you got out back or the thing you go to in the summer. What I mean is that they take all of the money and conglomerate it into one area so that when something happens, they can pull that money out. So when someone pays a premium, there isn't a little account for Johnny down the street with the insurance company. The insurer puts all of the money together and pulls it out when needed. That being said, everyone pays into the pool, but not everyone receives funds. So logically, some people may have several claims for which the pooled funds are used, and some people might not have any claims. So think about car insurance, for example. You may pay in your car insurance every month or every year, or however you pay your premiums, but you've never had a car accident. That being said, although you pay these premiums and you may not need to use them, you're still covered under a potential risk. So although people without claims are paying into the pool, they have the peace of mind that if anything bad happens, insurance will pay. Although we will talk in a different episode what certain exclusions are and what those mean, and how sometimes the insurers can get out of paying based on the language of the policy. Don't worry about that just yet, though. Another main concept in insurance is that the protection must be an insurable risk. For example, insurers won't insure an illegal activity. And let me give you an example of something that they wouldn't want to insure. Back in the day, I believe it was in, pre-1940s, people would purchase life insurance policies on another person and then kill them. I'm sure laws came out about it too, I'm not sure, but insurers began to include different terms in these life insurance policies to avoid that, because we obviously don't want that happening in our society. So there's examples of illegal activity would be purchasing a life insurance policy and then murdering the person or having them murdered. Or another example would be purchasing property insurance and then burning down the house. That actually happens possibly more than you would think with arson. And then one of the newest ones that I was listening actually to a podcast on before is flooding. So sometimes people will purchase property insurance, flood their house, and then take the proceeds. So insurers obviously don't want to insure something that will be illegal. So if you burned your house down, you wouldn't get the proceeds from it. Along those same lines, sometimes courts won't enforce an insurance policy if enforcement would go against public policy. One of those examples would be whether to insure punitive damages. And I can talk about damages in a later episode as well, but just very quickly, punitive damages are money awarded in a civil case to a plaintiff, the person who is suing, to punish a wrongdoer, aka the defendant. However, the majority of courts actually allow insurers to insure these types of damages. The argument against insuring these types of damages is that the punitive damages are meant to punish and deter the wrongdoer and other people who would maybe make the same decision. So why would we allow insurance to pay for that? And the argument, for is, well, it's insurance and they paid their premium, so the insurance should pay. However, there are a lot of insurance fraud laws to discourage illegal activity. Most states have a law in the book and potentially an agency that you can go to. You would just have to look at the specific jurisdiction. But there are quite a bit of insurance fraud laws to prevent this type of illegal activity and actions against public policy. Additionally, courts may void strike out a portion of the policy or find it void ab initio. And ab initio is one of those Latin terms that I was talking about in the very first welcome episode that I'll do a Latin terms episode here at some point. But void ab initio just means void, stricken from the beginning. If the court finds that the policy is void ab initio from the beginning, courts are split regarding whether an insured should be refunded for premiums, the money paid in, paid to the insurance company, or whether the insurance company gets to keep those funds. The argument for refunding insureds policyholders, is that if the contract is void ab initio, there was no contract to begin with, so the policyholder should be reimbursed for any payment made to the insurer. Now, the argument against is that the policyholder or the insured was, another Latin term, in pari delicto, which means in equal fault in the wrongly entered contract, and therefore, because they were equally at fault, they should not be refunded the premiums that they had already paid in. In addition to the risk having to be insurable, which we just talked about, a policyholder must also have an insurable interest. They must have some reason to make sure the thing being insured is not injured, whether that be a house, a life, a business, etc. This is one of those public policy implications again. The thought is that if there isn't an insurable interest, the policyholder may not take good care of the thing being insured because insurance will just fix the problem anyway. This concept is known as what we call moral hazard. When individual policyholders do this, it actually raises the premiums for everybody. So this is obviously not something that we want in society. Bottom line is, to protect the group as a whole, the people paying into the risk pooling pot, the government wants to ensure that insurance is only being triggered when a policyholder needs it. Now, that's just kind of the background on what insurance is and what it means. There's various types of insurance. You can pretty much get anything insured nowadays. The main categories I'll be discussing are liability insurance and first-party insurance. Liability insurance is covering you if a third party is injured and you are at fault. For example, in auto insurance, this would be the bodily injury coverage. First-party policies cover you if you or your belongings are injured. So if we keep on the auto insurance example, first-party auto insurance would cover first-party medical, first-party property, e.g. your car, or whatever vehicle you were driving, maybe a motorcycle, whatever the policy is insuring, first party is covering you, not a third person. And many policies will combine both coverages, such as auto insurance, as I've discussed. If you look at your auto insurance policy, you will probably see a liability portion and a first-party portion. And lastly, I just want to go over what this series will be discussing. In this series, I'll discuss types of insurance, whether that be life, commercial, general, auto, property, etc. Common coverage exclusions meaning an event happened, but because the exclusion was in the policy, the insurers don't have to pay. An insurer's duty to defend and bad faith claims, insurer defenses, and then policyholder counter defenses. That is it for today and for the introduction of insurance. If you have any suggestions for me about anything you'd like to hear in this series, please let me know. You can email me at contact@esquiredpodcast.com. Please be sure to visit the website at www.esquiredpodcast.com. And I look forward to introducing you to a new topic next week. Have a great week, guys.